Hi everybody, Brian Dightman here, and in this video I want to introduce a new technical concept called ratio analysis. It's very simple. It is used for the comparison of two securities against each other. And what I'm going to describe here is a fundamental characteristic I noticed starting to appear this summer, and that was around inflation. Recently I showed how Treasury inflation protected securities are outperforming or leading the bond market here in the US. We've also seen gold hold up pretty well. Silver started to also rise in price. And then now we're seeing commodities and basic materials. As a matter of fact, in the sector analysis I did on relative rotation graphs, we saw basic materials clearly in the leading category. So now what I want to do is use a ratio example to confirm that particular characteristic of price performance. And so we'll take a look at a chart now and I'll describe that in a bit more detail. I do need to quickly mention the information here is not a recommendation. If you're not familiar with our notice and disclaimer text, please take a moment to pause the screen and familiarize yourself with that detail. All right, on the screen right now we have a very simple line chart displayed. This chart goes back about 3 years. We are looking at weekly data, and it's clear most of this time period has been in a downtrend. Now what that means is when you're looking at a ratio analysis, you're comparing two symbols. You see them up in the upper left-hand corner. XLB is basic material. SPY represents the S&P 500. And when you have the line declining, that means the first security in the ratio is underperforming the second security. And then conversely, when that turns up, you'll see that indicates that the first security is starting to outperform the second security. If we reverse the order of the symbols, you'd see the exact opposite type of line drawn on the chart. What I want to point out is we clearly had a downtrend in this area, so we are confident that basic materials are underperforming throughout most of this time period. Only recently, let's say in the July time frame, clearly breaking that downward trend. We did have a period here where it looked like they were stabilizing, and perhaps in 2019 we could have seen a reversal. That did not happen. As a matter of fact, in 2020 it accelerated to the downside. That's even pre-COVID, because COVID really didn't start hitting until around this area here, where everything was falling. Basic material was actually falling more than the S&P 500. But it also started to recover better than the S&P 500, and most recently has had an accelerated price performance characteristic relative to the S&P 500. That's pretty bullish. I'm not making a recommendation here, but there are several fundamental factors that potentially are lining up to support this movement, this price movement. One, the inflation component I've talked about, where now Treasury inflation protected bonds are leading the market. Gold is holding up real well. Silver starting to perform better. We also see commodities and basic materials and that category of investments outperforming other categories of equities. The dollar's been a little bit weak. So when I am comparing a number of different investment opportunities, but I can only really select one in the end, I have to take a number of different factors into account. With this particular scenario, I think most of the fundamental characteristics that I just mentioned work well with basic materials. Again, this isn't a recommendation. It is just part of the process I go through in trying to decide whether or not other factors that I'm seeing, like the relative rotation graph, are playing out with a ratio analysis, for example, and what that looks like in terms of when we really started to see a price performance start to accelerate in this case, and that is just recently here. As we exited August and into September, it just had a really terrific spike up in relative performance. That's fairly bullish. It could be the beginning of an intermediate to longer term trend. Of course, it could also fade away very quickly. We don't know for certain what the future holds, but right now it looks like a turning point, and that's a pretty interesting development. One of the things I do when comparing different exchange traded fund investments is look at the holdings. And if I see a wider variance between the largest holding and the smallest holding, sometimes that can be an attractive characteristic. Not always, but sometimes. And the reason being is that much like a market cap index, what we would call the S&P 500 or the NASDAQ, essentially market cap weighted indexes, meaning the largest company represent the largest weighting in the index. Well, when ETFs are constructing their holdings, they can use a variety of different techniques for doing that, and market cap can be an effective way of allowing the largest companies, which are sometimes performing best, are sometimes providing more stability, etc. That can be a favorable characteristic when looking at an ETF. A lot of ETFs do not have a big variance between their largest holding and their smallest holding, and they're almost not necessarily equal weight. But if you go look at the equal weighted S&P 500 performance versus the market cap performance, equal weight has underperformed recently, and that's largely because mid cap and mostly small cap stocks have not participated in this rally to the degree that large cap has. So I use that as a characteristic when evaluating ETFs in addition to some of the other factors I'll be discussing. The other thing I'll mention in closing is the market is going through a bit of a correction, a pullback. Much of that is being led by the tech sector, in need of a bit of a breather. Some of those stocks may have gotten ahead of themselves, and so there's an opportunity here that seems to be materializing to rotate out of some of those categories and into something brand new, and in that providing a little bit of diversification to a portfolio. So when I look at all those factors collectively, there are a lot of reasons to be analyzing new sectors, new industry groups in terms of portfolio construction, and this is just a little snapshot of how we go about part of that process here at Dightman Capital. If you have any questions I can answer for you, don't hesitate to let us know. Contact information is on the next screen. Thanks so much for your time.